The most popular stock markets in the US were formed in the late 1700s. But when I was doing research for this episode, many online sources said that first listed company in the world was actually the Dutch East India Company. It went public in the 1600s and had a monopoly of the spice trade in Asia. Okay, we're not in for a history lesson today. We're actually discussing a more modern take on gaining exposure to the stock markets. To do that, we have Shanison Lin, founder of InvestingNote and Group Managing Director of ShareInvestor Group. And we also have Timothy Ho, Managing Editor at DollarsAndSense. So first question to you, Tim. Right? Why do you think companies want to be listed on stock markets?
When you are listed on the stock market, basically what you're doing as a company is that you're actually selling your shares to the public. Some advantages that companies enjoy when they are listed on an exchange is that they get access to public capital. So that also means retail investors can invest in your company, and that gives you a wider pool of investors. And I think the last reason is also a lot of companies that are listed on the exchange, public listed companies, they tend to have a much higher visibility. So if you look at some of the biggest companies in the world, Apple, Microsoft, they're all public listed companies.
So why should investors or traders be interested in the stock markets?
I think when people actually invest in the markets, right, what they are looking for generally is actually have a good returns. They want to make money from the stock markets. And stock markets actually provides the potential high return compared to, let's say, fixed deposits. And then if you look at the stock markets, let's say US markets, it's measured by, let's say, S&P 500. The index was actually formed in about 1957. So if let's say you put $1 over there, at that time until now, which is about 66 years, for $1, it's going to give you about return of $800 now. On the other part, it's actually traders like me, which is actually are looking for more alpha returns actually in terms of market. That means better return compared to just invest in the markets in the index.
The stock market in general has been moving up the last 100 years, or if we look specifically at S&P 500, 60 over years. But in between, I guess it doesn't move up uniformly. If you see stock price charts, it goes up, down. And that's where I think, Shanison, you say that's where you can get the short-term profits right from the market. So do we have to choose one over the other, like either long or short-term?
If you invest in a stock or index, then of course you hope that the price increase over the long term. But I think that's not the only way you can get exposure to the financial market. I think that's the reason why sometimes as an investor as well, some people may also make short-term trades. So they may take a position through CFD, contract for differences, where they actually look to capture the price differences in the short term. So this could mean prices going up, or it could also mean shorting the market if you think prices are going down.
So I'm just wondering, what are the key differences, when we invest, we buy the underlying stock versus when we trade in a CFD?
If you are looking for investing in the stock markets, you have to find a stockbrokers, right? But if let's say looking for a CFD product, you have to look for CFD brokers. There's a few there in Singapore. On the other hand, actually the difference is also the ownership. If you actually invest money into the stock market, generally you become shareholders. But for CFD-wise, actually it's different. Basically, it's called contract for difference. You are trying to make money based on the price difference of these instruments. You are not a shareholder. So you can actually capture the markets when the market was very bearish and stock market was going down. On the other part, it's actually is the access to the markets also, right? In terms of timing. So stocks generally you have to follow the stock markets. It changes opening hours, right? But CFD actually give you better access to the markets.
When it comes to investing in stocks, typically people don't really use any leverage. So you can do margin financing, but a lot of times people just invest for the long term. So they invest and it's just the capital they put in. But I think when it comes to CFD, leverage is something that's quite common. So you might have a capital of $1,000, but it might give you a 10 times position. So your position size could be as big as $10,000.
As investing typically is a bit longer term and trading is a little bit shorter term, what are some of the advantages trading the CFDs?
The biggest advantage of trading CFD, right, is also like points that the team mentions is about the leverage. So some of the company actually give you up to, let's say, 20 times of leverage. So if let's say you have $1,000, actually you can multiply 20 times. That's a position that you can actually go up to in terms of trading. And when the market is so bullish or bearish, and direction is actually very clear, and by having small capitals, but then bigger positions, that's potential bigger returns. The other part I would say is short selling actually becomes a way to hedge your position. Let's say you have a very big portfolio, which is long, right? You actually hopefully to hold position for the next 20, 30 years. But then if there's a market events happening, and then the markets have been going down, but you don't want to sell that because this is your long-term portfolio you hope to grow. And by doing the short selling using CFD, right, it's a way to hedging your positions.
So when we invest, we invest for the long term, and we may not buy or sell very frequently. We go in, we have a long-term view. But when we trade, the point is actually to go in and out a little bit more frequently, right? So Tim, what kind of costs can we expect to incur when we trade?
I think whether you invest or you trade, there are costs that you will incur, especially when you go through a brokerage firm, right? So I think when you invest, the first thing to note is that a brokerage firm will charge you a transaction cost. Sometimes they just call it commission. If you invest in an instrument like, say, ETF, exchange traded fund, there's also a fund management fee that will be charged as well. So that could be 0.5 to 1% per annum that is just charged on the fund as well. And I think the last thing to note, which a lot of I think a lot of Singapore investors don't frequently think about, is custodian fee. Particularly if you're investing in an overseas company or overseas stocks like the US market. So for an investor, if you're just investing a few $1,000s and you open a custodian, you need a custodian account to hold the US stock as well. And the custodian fee can actually be quite significant. When it comes to trading via CFD, the main thing to take note of is the spread. And then of course, if you hold your position overnight, there's overnight holding interest cost as well to remember. So of course, if you hold a long period of time, then you have the holding cost can accumulate.
What are some of the risks that we have to look out for when we trade?
The biggest risk actually is actually leverage. Although we say that this is the biggest advantage they have. When let's say you are actually longing a positions and the market is go against you, you can lose your money easily and very fast. And you can lose all your capitals you have. And that is actually the biggest risk, in terms of trading CFD. The second one actually is the counterparty risk, especially if you are trading CFD over single stocks. And if let's say that stocks actually go suspension, because of whatever reasons they suspended for trading, or actually the stocks, actually go delisting, and then you might lose all your monies you have. Because of leverage, you tend to over trading also in terms of actually CFD. And then you might be in and out trading too frequently. And that will actually result you actually, lose money, for that. And you have to actually watch out in terms of the frequency you trade.
How do we ensure that we're not taking unnecessary or excessive risks?
When you have a single stock CFD, you're also exposed to systematic and unsystematic risk. So unsystematic risk means risks that could only occur to that stock itself. So it could be something like fraudulent a hack or something that could affect the stock itself but doesn't affect the market as a whole. So when we trade single stock CFD, that is one risk that we are bearing. That something unique might happen to the company that may affect its share price. This is not to say that when you trade the market via CFD that you don't have that risk. There's still things like your black swan event. So things like COVID-19, war, these things can still happen and they will move the market. But those are the systematic risks. So those are the risks that we cannot really diversify away from. The end of the day, we don't own the underlying asset, right? So you have to ensure that your counterparty is a trustworthy provider, and MES licensed broker, in my opinion, is a must-have when you are trading in Singapore. There's so many asset classes that you can trade. I think the common similarity in all of them is that you must understand the market. You must understand what are the how the price movement tend to be, what are the factors that could affect the prices, right? Otherwise, you're actually just trading in the hope that the price will move in your favor. So I think that's very risky. I think one good way for new traders to start is, of course, to open a demo account first. I think there's two things a demo account do for you. The first is just to get familiarized with your platform. So you know how to put your orders, you know how to understand how to make your trade properly in the way you want to. The second is, of course, to try out your trading strategy. So once you have a trading strategy in mind, you want to implement it, you want to have a bit of confidence in it before you actually put actual money, and that's how a demo account can help you. Even after you move to a live account, if the price move against you, you must be able to cut your losses quickly, right? And that's where things like your guaranteed stop loss is quite important, because otherwise you might bust your account just because of one trade in which you never put a stop loss.
Okay, thanks Shanison and Timothy for sharing your insights on the stock market and trading single stocks. The main benefit of trading single stock CFDs is that we don't own the underlying stocks, but we gain exposure to its price changes. Unlike investing in the stock itself, we can also take a short position when we trade single stock CFDs, which can be useful especially if we want to hedge our existing long positions in the market. We should also understand the risks involved in trading single stock CFDs, especially since we are employing leverage. This can magnify both gains as well as losses. Single stock CFDs may also be more prone to liquidity gaps, where prices gap up and gap down. beyond our expectations and even our stop loss orders. Trading costs can also significantly eat into our profits. In general, we should pay attention to the bid-ask spread as well as the overnight financing costs that we incur. To hone our trading skills and test out new trading strategies, we can use a demo account offered by most CFD brokers, including Oenda, our sponsor for this episode. Once we are familiar for trading on the demo account, we can be more confident and progress to a live account using real money. While our sponsor for this episode does not offer single stock CFDs, we mutually agreed that it was important for us to educate investors to learn more about the stock market and gaining access to individual stocks. On Oenda, we can gain access to the stock market as a whole on its indices CFDs. Okay, thank you.
Thank you for having me today.